Asian shares declined sharply on Tuesday as concerns over the health of global financial markets deepen. U.S. President Joe Biden has promised to do whatever is needed to strengthen American financial institutions after the collapse of both Signature Bank and Silicon Valley Bank. Biden has told Americans that their banking system is safe, even as fears of another U.S. banking crisis rise. The two bank failures are the worst since the 2008 global financial crisis, and they have taken their toll on the markets.
It was another turbulent day on the Asian markets as Tokyo stocks closed down 2%, despite reassurances from the US President Joe Biden. EU authorities say they are monitoring the situation, but do not expect the US failures to cause long-term problems in Europe.
We take note of the swift and decisive reaction by the US authorities. Within the EU, there is a very limited presence of Silicon Valley Bank, and of course we're in touch with the relevant national competent authorities.
That message was echoed by EU finance ministers, including Germany's Christian Lindner.
We've got our own authorities in Europe. In Germany, for example, we have our own financial regulatory body, which is continually monitoring the situation. These institutions have no doubts whatsoever about stability.
This changes nothing for Germany.
Nothing. I have faith in Germany, colleagues. Bye-bye.
In the US, the failures have brought back painful memories of the devastating meltdown of 2008. In a bid to lessen uncertainty and avert further banking runs, US President Joe Biden hurried to reassure the public.
All customers who had deposits in these banks can rest assured, they'll be protected and they'll have access to their money as of today. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund.
Biden stressed that, unlike in the past, irresponsible behaviour by banking executives would not be tolerated.
The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again.
Those rules were introduced after US banks sparked a global financial crisis in 2008 by aggressive mortgage lending. They were partially repealed in 2018 under then-President Donald Trump. In the coming days, that decision is likely to be back in the spotlight.
DW Business reporter Andrea Napori is on the story for us. So where does the situation now with Silicon Valley Bank stand after Biden's speech yesterday?
So from a practical standpoint now, depositors have started to withdraw their funds. The requests to withdraw are going through. They're doing that through a breach bank that was established by the US government. And apparently, of course, it's a little bit of a mess right now. A lot of people are requesting these withdrawals. So there's some reports that people had to try thousands of times before they were able to get funds. And mostly we have to always remember these are funds that these depositors are taking out to pay their employees. They weren't able to do that last week. A lot of up to 5,000, I think, tech startups were depositor into Silicon Valley Bank. So that's what's happening on the ground now. It's clear that indeed what President Biden promises is happening. So people are actually able to withdraw those funds, and eventually everyone will be made whole. Regarding the banks are now officially seized. They will cease operations. The management will be fired, so they sort of cease to exist. Their funds will be seized, and they will be used to recoup the investment.
And the big hope is that this will provide an injection of confidence that will prevent another banking crisis like the one that we saw in 2008. In terms of where things stand right now, how high is the fear that we could see another banking crisis?
Well, the fear is there, absolutely. I would say that the U.S. administration was pretty quick. They worked over the weekend with these measures seem to work to appease at least depositors. There was a big political stance here that was way different from what we saw in 2008. They stressed that this is not a bailout of investors in the banks. Actually, investors will shoot a cost for this mess. They took a risk, Biden said, and this is capitalism, and capitalism risks can sometimes not pay out. So it's not a bailout of investors. The depositor will be protected. And what's also very different is that what we're seeing is not banks selling toxic derivatives to the entire global system in a scheme that was overlooked for too long. Now, this is a case of appalling mismanagement and appalling risk management, especially from Silicon Valley banks and other banks. They took too many risks on long-term interest-related products. So with this kind of products, when the interest rates were low, well, the value was high. Now that the Fed decided to hike the rates, of course, those products are less valuable. When depositors started to run on the bank to take their deposits out because they probably sensed that something was wrong with the bank, of course, that the bank didn't have liquidity to honor those requests. As a consequence of the bank run, so the bank sort of had to fold. It collapsed because it couldn't honor those requests. Something similar happened to Signature. They were also exposed to crypto assets, but at the same time, in that case, the government intervened faster and blocked the bank.
What do the markets make of all of this?
Well, they're clearly jittery. We've seen that they don't like, I would say they don't like especially what President Biden said. It's as if sometimes capitalists don't like to be reminded.
Why? It's not enough of an assurance?
Well, it's definitely a reassurance for depositors because they're being protected. But Biden said, this is capitalism. It sort of said like this kind of, it's capitalism baby kind of thing, where he said, you took risks, you're gonna now shoot the cost for those risks. So there's uncertainty that other banks might go the same direction. And as we know, uncertainty is not good for markets.
DW business reporter Andrea Napori, so much at play here. Thank you so much for walking us through it.
My pleasure.
Hans-Peter Burkhoff is joining me now. He is chair of banking and financial services at the University of Hohenheim in Germany. Mr. Burkhoff, at the heart of this story, as we just saw, are rising interest rates. We're not only seeing those in the US, though. The ECB, for example, is also jacking up rates. Can we expect more collapses of these smaller regional banks to follow in other countries?
No, not really. We can't expect that. What we must say is that the fast increase in interest rates the ECB was forced to undertake due to inflation leads to certain vulnerability. And this is very evident in Europe. The ECB should have started 1 year early with increasing interest rate. Now it has to do it very steeply. And this means long-term bonds lose a lot of value. And if you have to realize this value, you're in deep trouble. But it's a question about trust. SVB in California was a classical bank run. When there's a run on liquidity, no bank really survives that. And this bank was particularly badly placed to cope with such a problem, as they didn't even made a proper risk management of the interest rate exposure.
Okay, so this seems to be contained likely to the specific bank. Now, the Fed is meeting again next week to decide on interest rate increases. Before the bank collapsed, investors expected more rate hikes on the horizon. Now, do you think that the Fed will continue its course of higher interest rates despite the bank collapses?
I mean, inflation is still there. It's a task of the central bank to fight inflation. So I think there will be increase, but maybe to reduce stress in the banking systems, they might be willing to get on more slowly to avoid that things go wrong. But some market participants said that the interest rates might even fall. This would be a signal that we're in a deep crisis already. And I think this is a signal the Fed would not like to place.
Okay, so high interest rates are a good sign in this case, according to you. The bank collapse has spooked investors worldwide, as we mentioned. And for many, it's conjuring up images of the 2008 collapse of Lehman Brothers, which really reverberated around the globe. It wasn't just contained to the US. Now, there are worries that this one will be the same. Could you perhaps elaborate on how far it is similar or in how far it is different?
Well, this crisis shows that banks generally are vulnerable because they serve as a liquidity pool to the economy. So attacks on this liquidity by doubting investors will always lead to a banking crisis of the respective bank. But what's definitely different is we had this big U.S. housing market financing debacle where lots of houses were financed that had much less value than there was loans placed on them. And so we had actual losses from defaulting house owners to a great degree. And due to the securitization of these claims, this risk was spread worldwide. We're on a totally different level now. SVB is a comparatively big bank, but it's not spreading its risk really worldwide. It has some influence on the financing of small tech companies in some countries, but this can easily be replaced by other banks or, if necessary, by the state. So we are in a different situation at the moment, but we must take care that this crisis doesn't evolve in a certain direction.
Speaking of evolving, the US government and the Fed are now guaranteeing businesses will receive their deposits from the collapsed banks. Do you expect that this move will prevent any further collapses and will really stop this panic that's so detrimental right now?
One thing is, do we trust in the banks? And there might be some doubts in the United States because there had been some deregulation. And seemingly the level where we have a lower level of regulation has been raised to 250 billion total assets. And banks with a little bit less than 250 billion, these are already very big banks and have a tendency to be systemic. So I think there's some problems in the regulation in the United States. The state have to cope with to come back to trust. The main reason, I think, for this guarantee was a different one. It's about Silicon Valley. Silicon Valley is very important for the United States. All these small tech companies are seen as the guarantee for future growth and technological advancement. And if these companies get into trouble, this might have long-term negative impact on growth in the United States and on its position in the world as an economic power. So I think that's why Biden was willing to guarantee all deposits, although she was not obliged to do so.
Hans-Peter Burkhoff, thank you very much.